Yeah, hello guys, it's Kingsman Trading here. On this particular video, I'm going to be teaching you all the foundation of technical analysis, and you all know what it is. It is market structure, and in as much as I've done this video multiple times, I would love to explain it to you. So most of you all might be familiar with everything that's going to be said there, but for the sake of beginners and people that are just starting new, let's dive into it. So now we all know that market moves in three major directions, which most of you are already mentioning them right now as I'm about to type them out. So market move in uptrend, then we'll have the downtrend, and then the sideways. Yeah. So these are the three major movement of markets. So anytime you see a trend, you know it's either one of these three. So now for an uptrend, it's a situation whereby we see price create series of higher high. You see price create a high, and then it creates a low that failed to break this previous low, and then it went up again to break the previous high, creating another higher high. Then you have another low. Now this low now is higher than this low right here is higher than this previous low. So it's going to be a higher low. Now, as price progresses, creating this series of this particular move, that's what is identified as an uptrend. Because obviously now you can see that price is going up, is bullish. So now in an uptrend market, you want to be looking for buy setup because you want to trade in line with the trend of the market. So now this is an uptrend, as you can see. If you mark it out from here, you see, oh god, I miss my. You mark it out from here, you see this is a very good uptrend, and then for a downtrend, it's just flip the uptrend and then you understand. So for downtrend, you see price create a high, then a low, then it creates another high that is lower than this previous high. So it's going to be a higher low. Then it's come down, it broke this particular, it breaks this structure, create another lower low, and then lower high, lower low, lower high, lower low, lower high, and so on and so forth. And in this kind of market, you want to be looking for sell, you want to be looking for short entry, sell setup, so that you're going to be trading in line with the structure of the market. You don't want to trade against the structure. Then for a sideways market, this can also be called a consolidation phase, whereby market is still at an indecision. You see price be moving in a particular direction without creating new highs or new lows. You just see price moving in can be a loop whereby price did not break this previous high or break this previous low. So this kind of market is very very risky, and you need to be highly knowledgeable for you to catch a particular move, because what we're going to be anticipating in this kind of market is a breakout. And most of the times before this breakout, there are a lot of manipulation because there are buy side liquidity resting above and there are sell side liquidity. So you don't know where price you that is selling here. Most retail traders that do take this trade, they place their stop loss above this point here. And most retail traders too that is also buying from here, they place their stop loss below this point. Whereby we know what moves the market. Liquidity is what moves the market. So if price want to, for a successful money transfer, there have to be a sweep of liquidity, and then there's liquidity resting above, there's liquidity resting below. Price will not just expect price to move up here and neglect the liquidity that is resting below. So what market is going to do is, you see this offer, market is going to look for a way to um, take out the buy side, then it's going to take out the sell side. Then before it's going to have a series of a short period of correction, then it can now continue either to the upside or to the downside. So you have to be highly knowledgeable in technical analysis for you to trade a consolidation market. Otherwise, you're just going to you see a scenario whereby you try to buy, market take you out, you try to sell, market take you out, and then you try to buy, market take you out. Probably if you're trading, or if you're not trading with good risk management, you just see that price, or probably you've blown your account before price will now start moving on the direction it's supposed to go. So a consolidation phase or a sideways market is something you want to avoid, especially if you're not very familiar with the concept of liquidity. So for now, this is it. And then change in state of delivery, which is a market structure shift. This one can mainly be used for reversal. Now, for an uptrend market now, whereby the market is going to reach a point whereby it wants to start selling, because after a buy comes this video that I didn't want it to be long, but then it's really really long already. So then for a buy for an uptrend movement, price will eventually reach a point whereby it's going to reverse and start selling. So that point now, what you want to see is price reach a particular high, and then it failed to break this structure. Then now it creates a low most of the times. Sometimes can just go down here, break this previous low. This can happen, and then create another high. Create another high that fails to break this previous high. Then automatically it's going to confirm your sell, or your change in market structure, or change of character, as you popularly know it as. So in such scenario, you want to be very conscious of what price is doing, so you don't try to buy when market has already reversed. And also for the sell too, you might see something like this, whereby price is going to get to a particular level, and it's just going to do something like this, create a failure swing, yeah, and then break structure. Now multiple break. Now what you'll be anticipating is price to get to this point, then you long. So on the next video, I'm going to be explaining to you all in full details, giving you the chart example of what I've just said here. So that will be all for this video. So guys, so this video now is going to be in respect of our previous video on market structure, and on this is the GBP USD 4-hour time frame, to be precise. So now I'm going to be using this chart example to explain the market structure, which is the basic market structure. So right here we have price gave us this high, a low. So now this is going to be a higher low, because this low is higher than this previous low. Then higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Let me just make this faster. Higher high, higher low, higher high, higher low, higher high. This is the sponsor low this is the low that sponsored the break of this previous high right here. So this is the higher low. Yeah, this is the valid one. So right here now, there is a change of character, like I said towards the end. There's a change of character, change of trend, whereby price is going to move from an uptrend to a downtrend. So after price created this high, what are we going to be anticipating next? We want to see price create this higher low, and then create another higher high that is going to break this previous high. But what did price do? Price came to this point, it created this lower high. Now this is a lower high because this high is lower than this previous high, and then boom, there's a break of structure. So now automatically, this is now your market structure shift, or your change in state of delivery of the market, whereby you'll be anticipating a sell. You'll be anticipating a sell because price has obviously signaled a bearish move. So now based on the structure, after price broke this structure here, this was a protected low. This was a protected low that is now invalidated. Now, why is this called a protected low? Now, why this low is called a protected low is because it did not only sweep liquidity of this previous low. Two criteria that I consider a protected level for me personally is, number one, I want to see that low take out liquidity. I want to see a sweep at that low, either a sweep of the previous low or a sweep of the previous candlestick, which happened there. So there is a sweep of this low right here, and then this low now sponsored the break of this previous high, whereby price created this new higher high. And then after saying that, price gave us this failure swing. This is a failure to swing because it failed to swing above this previous swing high and give us another higher high. So now we have this low, and then price is retracing to this point. So now if we're going to be looking for a setup based on this narrative of the chart already on GBP USD 4-hour time frame, we'll be looking for a sell, and I'll be looking for either my entry model or a particular unmitigated level that price is most likely to take out, or my liquidity level. So now I'm going to do my draw on liquidity right here. Now this is a buy side liquidity. This high here is a liquidity that must be taken out. This is a liquidity peak now. Is a liquidity. This liquidity has been taken out. Price take it out and then is reacting from there. Now also, this is also another liquidity again. This is also another liquidity that must be taken out. Then now, this right here is supposed to be a buy side liquidity, but most people always confuse this buy side liquidity for, they don't know when price has obviously taken it out. Now this was the major buy side liquidity that has been taken out. This one here. So price created this high. It had this retracement, which already made this point to be our buy side liquidity, and price came to this point and then it took it out before breaking this structure. So now, if I'm going to be looking for an entry, this is going to be based on the higher time frame. Now this is not substructure. I'm going to get to that part now. So now this is going to be our point of interest. This last bullish candle, since it's a sell setup, we'll be using our last bullish candle because, you know, in a sell setup, your point of interest, your order block is the last bullish candle before a bearish move. So right here now, this is my POI. Now, this is based on the major structure. Now that price broke this low, we are now anticipating sales, and anything that happened within this point, within this, let me mark it out. Now, this is the structure that we're looking at now. This high, and then this low, based on the 4-hour structure. This low. So now anything that is happening here, any high or low around this point, is an internal range. Now, for us to be able to catch a major move, it has to happen here. So now with price giving us this failure swing, having this major break of structure, invalidating this previous protected level, it makes this setup most likely going to hold, because this high has been swept, this buy side liquidity has been taken out, and this structural liquidity is what's going to attract price to come back to this POI. So now this is going to be our setup. We'll be targeting this low, and then our stop loss is just going to be at this high. So some people now will be looking for setup inside this structure. Mind you, on a particular trending market, This is your major structure. Now for a downtrend now, this impulsive move to the downside is your major structure. This retracement is your minor structure. This is the major structure. So now if we're going to be looking for sell, and then this is our swing structure. Yeah, let me say this is our swing structure. Yeah, this is our swing structure. And we also have this point again to be our swing structure based on that time frame that we're looking the market on. So if these 2 points are our swing structure, if we want to target a major move, it's going to be from the sponsor high or from the sponsored low. That's what's going to make that trade most likely going to hold. So now, me now seeing an entry model or a particular sell setup from this point is very much more valid after adding other confluences, and me also seeing a sell setup, a buy setup from this point here, especially when price has given me some kind of confirmation like a failure swing, and then I'll just expect price to come back to this point here and then target the next swing structure. So now anything for a sell now, anything that happens in between this point, in between this sponsored high, is going to be a substructure, whereby it's very risky. You have to be fully aware of what you're doing and understand the concept of liquidity when trading your substructure. So with that being said, I think that's going to be all for this video, and let's see how this setup plays out. One more thing, please try trading more of the major structure, and that way it's going to help you to take high probability setups and few trades, because that way now you won't be trading, you won't be over trading, and it's going to make you to hold your trade down to TP, especially when you're trading from the higher time frame. So that's one of the advantage of trading the higher time frame and the major structure. So take note of that, guys, and watch how your win rate is going to increase. Trust me. Yeah, so that'll be all.
Yeah, so guys, on our previous video, I spoke about market structure, which I gave you guys chart illustration on GBP USD based on the basic market structure. So right here now, I'm going to be clearing this chart off because I want to be explaining the advanced market structure. I want to be explaining the advanced market structure, and I think I started from this point. Okay, as you can see here now, also this is still an uptrend market. So now let me try to simplify what happened here. Now, hold on, sorry. Let me try to adjust it so you guys can see it very clearly. Yeah. So now let's start from here now. Now we have this low, we have this high, we have this higher low, higher high, higher low, higher high, higher low, higher high, higher low. Then what did price do? Price came here and then it came back here to take our liquidity. Came back to take our liquidity and tap into an unmitigated zone from this point. Now it created this another. Now this is not a reversal. Now after price did this, it went back up and created another higher high here and another higher low. Now it created this point. This can serve as an internal rate liquidity, and then price still came back and take out the liquidity from this low. So now this is what's happening. If you look closely on the chart, this is what's actually happening. Price is taking out liquidity and is filling unmitigated zones while it's going up. Right here again, we still have this points. Price came back, fill another unmitigated zone here. It went up again, higher low, higher high, higher low, higher high. Price came back down, took out liquidity, tap into an unmitigated POI, then continue movement to the upside, higher low. Price came back, took out liquidity from these lows, fill another unmitigated POI around the side, and then it's continued movement to the upside. So that's basically what's happening. Price is going up, it's coming down to take out liquidity and fill in and take orders from an unmitigated POI. So now, zones that are left unmitigated is going to attract price to come back to that zone because they are pending orders, they are resting at those levels. And with liquidity resting above an unmitigated POI, is going to attract price to come back to those level and fill it before continuing movement to the upside. So now market price movement is not just as easy as just higher high, higher low, higher high, higher low. A lot of things happen. That's why when I started learning at first, I learned with this. The video I watched was just higher high, higher low, higher high, higher low, and so on and so forth. But then, if I enter the chart, it's very difficult for me to be able to identify all those highs and all those low because I did not understand. I didn't know that price is taking out liquidity. I wasn't knowledgeable about it then. So now let's just finish the movement to the current price action. So now price created at this high, higher low, higher high, higher low, went to this point, came back down, take out liquidity from this point, fill into this, tap into this unmitigated zone here, and then continue movement to the upside until it got here, and then it got here, and then price have this little retracement. It came back up here, it take out liquidity from this point, and then gave us this gave us this higher low again. It went up here. Now, this right here can be identified as a failure swing, but it's not a valid failure swing because price did not really break this major structure. Like I said, this is our sponsored low. This low sponsored the break of this previous high. This is what sponsored this new higher high that price created here. You understand? So now for this failure swing to be valid, price have to break a previous protected level. So now because the protected level is not broken, this is not valid because price can still tap into our mitigated zone around any point here and then still create another new high. So after this price went back down here, I think it was at this point that price broke this protected level and then gave us this swing high. Sorry, this failure swing. Now, why this is called a failure swing is because it failed to um create another new high. It failed to create another new high, but because of this failure swing, it created another lower low. Mind you, price has been moving in a series of higher high, higher low, but now we saw price give us a failure swing and then another another lower low. Now after this, we are now going to identify our liquidity and unmitigated zone for us to be able to identify our next point of retracement where price most likely gonna retrace to before we follow the sell, before we join in with the current structure of the market, which is obviously a sell. So right here now, this is where we have our market structure shifts. This is where we have our market structure shifts, where this protected level got invalidated, and then this is a failure swing. 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 And I'm going to be taking this point as our structural liquidity. This is what's going to attract price to tap into our POI. Now, this is our liquidity now. I expect price to come and take. This is our liquidity. And now for my POI, this I'll be looking for now because of the fact that this is a reclaim block, price take our liquidity from this point. I'm going to be using this candlestick right here. So yeah, this is the setup I'll be waiting for. Now for me to be able to ride with the downtrend because price just reverse. Now price just reverse. There is a change of trend. Now price is no longer moving in series of higher highs, higher low. Now we are seeing price breaking structure to the downside. As you can see here, as you can see right here now, we have a break of structure to the downside. And now, because of what happened there, because of this failure swing, this protected level that got invalidated, we'll be expecting price to tap into this unmitigated POI, take out this liquidity, and then and come back down and take out this low, then come back down and take out this low. So that's what I'm anticipating for right now. So any other any other structure you're seeing here, or let me say some people trying to sell from this point, it's most likely not gonna hold because this is now the substructure. Now the major structure, like I told you all, is always the either the high or the low that sponsored the break of the previous major high or major low. That's where the reversal or the change in market or the change in state of market delivery, that's where it happens. So that's where your high probability setup lies. So that's basically all for this video, and I'll see you on the next video. Let's see how it plays out. Let's see how it plays out. Oh, you're still waiting? I'm done with the video. You can exit now. You can go. You can actually leave. What are you waiting for? I said I'm done with the class. Yeah, thank you all for watching.